Hey everyone, JPA Trades here. I guess Happy New Year. Welcome to 2022. Hope we can start the year off right. So, what we're going to go over today is position sizing as well as what contracts to buy when you're looking for these new positions. So, in all my educational videos, I like to just start out assuming everyone knows nothing, and that way we can build some knowledge throughout the video and hopefully set you guys off with enough information to be dangerous going forward. So, what is position sizing? So, the definition of position sizing, just position sizing refers to the size of a position within a particular portfolio or the dollar amount that an investor is going to trade. Investors usually position sizing to help determine how many units of security they can purchase, which helps them control risk and maximize returns. So, the key words there is control your risk and maximize returns. So, everyone's risk tolerance is different. This video, I'm going to go over kind of the risk tolerance rules I use, as well as give some rules that you can use for your own portfolio. But the key is to manage your risks and make sure you're not oversized. So let's see what we're talking about here. So here's just kind of the examples that I like to go by for my personal investing. So option position sizing versus a stock position sizing. So option position size, I don't like to let them get bigger than 3 to 5%. And I know this isn't possible for everyone, especially starting out. You might start out with only $500 or $1,000, and you say, "Hey, if I want to make a play, I have to put almost my whole account in." And I understand that's difficult, and I'll kind of show an example of how to do that if you had $1,000 in the coming slides. Whereas a stock position, I won't let it exceed 20% of a portfolio. But as you can see, that's a much, much larger size, and that's just basically because options are a high risk, high reward position, and stocks are low risk positions. So I could get toasted, you could get toasted overnight in an option position, but your stock position, it's much more likely for you to be able to. You can ride the storm. Stocks go up, stocks go down, but over time, if you're in the right company, you'll eventually see your money back. And in the meantime, there's covered calls and covered puts and spreads you can do, and maybe I can cover that in another video. But stocks are just a safe place to put your money if you're in the right company. Like if you put it in Apple or Amazon, your money is never going to go to zero. It might go up, it might go down a little bit, but over the course of the year, 5 years, 10 years, your stocks should keep going up. And that's where you can hold a stock forever, but option positions eventually will go to zero or expire. So if you're in an option for too long, it doesn't get the way you want, it can just zero out when it expires. Whereas, like I said, unless you're in a growth stock, some real flyer you're taking, it's very unlikely to go to zero. The big tech stocks that you invest in and kind of a safe place to put your money, they might go down even 20%, but at this point, Apple's not going to go to zero, Amazon's not going to go to zero. It's just kind of a safer spot to put your money. So, as I said, the position sizes for a new account. So, I think $1,000 is pretty fair to say for a small account, and you can scale this up or down. So, if you had $10,000, just use this. You can use the 3 to 5% rule. If you had $2,000, still kind of keep that level in place. But $1,000 is a pretty good place to start. So what you want to do is you want to keep your size under $250. So I know that's 25% of your portfolio, but that's more than enough. So if you're out there, just 250, keep getting those wins under your belt. You take the 250 or 1500, you keep doing 250 over and over and over again until you're eventually big enough that you're only putting that 3 to 5% in. Because eventually you are going to get a bad gap down. You're going to get a trade to go against you. Something's going to go wrong, and that position's going to zero out. You're sitting there with your full $1,000 out there. You're eventually going to get toasted. And that's why I have the next rule: do not exceed 3 open positions at a time. So even if you had all three $250 positions out there, and they all go against you, all go right to zero, you still have something left. But you can't all in one position $1,000 because it eventually will not work. And then what else you need to do is you need to lock in half of the position by 100% gain. It doesn't matter if you're in the strongest stock. If you're like, I know this is going to keep going up. I know it. I know it. I know it. More often than not, your emotions get the better of you. If you can lock in profits up to 100% and make that rest of the position free, that's how you can really hold for those big moves. The biggest moves in options normally happen in overnight swings. So if you had a play that went from $100, from 250 to 500, if you could remove 250 from risk, which was your initial entry price, that last 250 is house money. You're playing it for free. Even if it goes down to zero, you still break even. Even if you can get out at negative 50%, you still break even. But if you get some huge gap up or huge movement in a stock, that remaining 250 might go 5 or 10x if you get the right play, if the contract you got was cheap enough. And that's how you can really get the snowball rolling. And then all that dollars you keep getting, it makes that 250 less and less, and you keep working it from 25% of your account down to that 3 to 5%. And once you're kind of at that 3 to 5%, it's hard to get, like, you have to be wrong if you're doing 3% 33 times. Like, you're not going to be wrong 33 times in a row and lose all your money. It's all about minimizing risk and maximizing rewards. And like, here's an example of this: the three position rule. So let's say you take one position, $250. You ride it out. You're like, you get $300 at the end. Oh, that's awesome. Take another one. Take 250 to 750. Oh, that's even better. So 500, and you're feeling good. And then rather than go all in and load it back in, your last position might go to zero. You lose 250. So if you put that full $1,150 you just made, your last position went against you, and you got toasted. But instead, you only kept that same base position size. You lost it all, but you still netted out $300 and keeping that account growing rather than going and just resetting yourself. It's all about keeping you moving forward. You never want to be in a position where you reset yourself back down to zero, where you take all your money off the table. You want to keep making that grind forward, even if it's a slow grind forward. So that's good and all, but how do you know what options to buy? It's like, what can you buy that's the right price? Like, you don't want to go out there and buy a $10 Tesla call with all your money. You don't want to be buying these huge expensive contracts. You want to be looking for something that's around 50 cents to $1.25, because this allows you to buy those multiple contracts so you can do your trims. Like, if you bought a $250 option contract and that's all you have no ability to trim it. You have no ability to walk your way in, walk your way out. You have one shot, and that's all you get. So if you time it bad, you miss out. If you time it good, you get everything. But that's not the position you want to be in. You want to be in a position where you can trim some when it's going with you, and then hold for the rest. And then maybe you get the big move up, like I said, and maybe you get the big move down. But by expiration, though, you want to have the contract triple based upon the underlying stock price is the rule I use. So what's that saying is you don't want to be there playing premium. You want to be playing the intrinsic value, which is when stocks go in, when the option contract goes in the money, you want to be triple what you paid for it. Not, oh, if I see a big bounce here, this contract will triple, because eventually it's going to go against you. So kind of what I'm saying here by the triple on the underlying example is, if you buy weekly Apple 180 calls for $1, that means by Friday, Apple will trade at 183. So you might have to pay. Apple might be $1.78 when you buy these, and by the time Apple goes to 181, if it happens in the same day, you'll get that 180. You'll get that triple, but that's you're eventually going to get burned that way, because premium increasing is a good way to make money for the small moves, but eventually it's going to burn you. You don't want to be playing a premium change. You want to be thinking, hey, I actually think this underlying stock price can make it to that triple my entry fee. You don't want to be in there splitting hairs. You're like, oh, if it jumps up $2, I'll make my money, because, as I mentioned in my other videos with theta decay, every day theta hurts you more and more and more. So you need to be targeting a move, not targeting just people are going to rush into that contract. So with that being said, I hope this video helped you guys learn a lot about option sizing and positioning. So with that, have a good weekend, and I'll talk to you next time.